Why does your tax return show a large profit when your bank account is almost empty? For many small businesses, the answer has been the mandatory capitalization of research expenses. But for this tax season, a new provision called Section 174A has changed the landscape. No matter which business type you are, sole proprietor, LLC, S-Corp, or C-Corp, this is for you. Today, I'm going to show you how this law allows for a significant reduction in your 2025 tax bill and may even trigger a refund for prior years. To use this rule, your expenses must qualify as research and experimental, or R&E. While that sounds technical, the IRS definition includes most software development, product design, and even significant improvements to existing manufacturing processes. And here's a common question in 2026. Does AI development qualify as an R&E expense? The answer depends on the nature of the work. If you are simply using an AI to generate standard code for routine tasks, it likely does not qualify. However, if your team is using AI to develop a new proprietary system or solve a complex engineering problem, the cloud computing costs and the wages of the staff managing that AI are eligible. The focus is on the technical challenge you are solving, not just the tool you use to solve it. Okay, so what has actually changed? From 2022 through 2024, the law required businesses to capitalize these costs. This meant you couldn't deduct the full expense in the year you paid it. You had to spread it out over 5 years. This created what many call phantom income, where you owed taxes on money you had already spent on development. As part of the One Big Beautiful Bill Act in 2025, Section 174A has been introduced to allow businesses to return to 100% immediate deduction for domestic research starting in the 2025 tax year. Let's look at an example here. Consider a C-Corp generating $1 million in gross revenue with $500,000 in R&D spending and $300,000 in additional operating costs. In the past, you were restricted to a first-year deduction of just 10% or $50,000, resulting in $650,000 of taxable income and an estimated tax bill of $136.5 thousand at the 21% rate. However, Section 174A allows for the full $500,000 deduction, potentially lowering your tax liability to $42,000 and securing a $94.5 thousand saving. Now, if you're an LLC, this isn't just a business problem, it's a personal one. Let's say you earned $500,000 and spent $200,000 in development costs and another $200,000 in other costs. Under the old rules, if you're in the 24% bracket, you'd owe over $67,000 in income tax on money you already spent. On top of that, you might owe over $31,000 in self-employment taxes. Section 174A wipes that out, saving over $63,000 of your hard-earned cash in your own pocket. Now, there is a specific provision for businesses with average annual gross receipts of $31 million or less. These companies can elect to apply Section 174A retroactively to the 2022 to 2024 tax years. This allows you to catch up on those deferred deductions and potentially claim a refund for the taxes you paid during the amortization years. There are two primary paths you can take. Path A, the amended return method. The business files an amended return for every year affected. It is all or nothing. You cannot pick and choose to only amend 2023. If you make the election, you must apply to all years in that period where you had domestic R&E. You must attach this very specific statement to each amended return. If you miss one year, the IRS could technically disqualify the election for all of them because you failed the consistency requirement. You must file by the earlier of July 6, 2026, or the date your statute of limitations expires, typically 3 years from when you filed the original return. If you filed your 2022 return on April 15, 2023, your 3-year window for a refund expires on April 15, 2026, not July 6, 2026. Path B is the catch-up method. Now, instead of amending the past, the business can make an automatic accounting method change on their 2025 tax return. This uses a Section 481A adjustment. Essentially, you calculate all the deductions you should have taken in 2022, 2023, and 2024 but didn't, and you take them all at once on the 2025 return. This is often preferred because it provides an immediate wipeout of the 2025 tax bill without waiting for the IRS to process three separate amended returns. The deadline is April 15th, 2026. With an extension, while the 2025 return isn't due until October 15th, you have a hard statutory cutoff of July 6th, 2026 to elect for this relief. Before you file, keep three things in mind. First, Section 174 does not apply to land, depreciable property used for research, or oil and gas exploration. Second, foreign research activities continue to be subject to the Section 174 capitalization and amortization requirements, which generally means a 15-year waiting period. Finally, the catch-up deductions from 2022 to 2024, when combined with your 2025 deductions, may trigger the Corporate Alternative Minimum Tax, or CAMT, for larger entities. To see if Section 174A applies to you, look at Form 4562 on your tax return. If you see amortization related to Section 174, you should talk to your tax professional about Revenue Procedure 2025 to 28. It provides the official roadmap for making this transition. If you found this update useful, please subscribe for more tax and finance updates like this. Thanks for watching.